Hey guys, this is Ken McElroy, and you are listening to the Mailbox Money Show with Bronson Hill.
So if you're like me, you're asking a lot of questions about multifamily real estate. How are deals actually working? I'm hearing about deals that are in trouble. Should I be investing now? What about my current investments? How are they performing? How do I know if I'm at risk? These are all questions people want to know. And that's what we're going to jump into today. I've got my good buddy, Sam Sells, with me, who's an operator and a friend, and who's done lots of different value add and different sort of development projects. And he's got an insight into what's happening in some of the markets that he works in. So, Sam, really excited to have you here today. How are you doing, man?
Yeah, I'm doing really well. It's a beautiful day here in Texas. It's 80 something degrees in February, which is crazy. But
Yeah.
always good to talk to you, man. It's always
Good
fun.
talking to you, man. Yeah, it's actually, I think it's 49, 46 and raining here in LA. So we've had lots of rain, this big storm coming in and everything. But
Yeah.
yeah, man, been great to be a part of Kingdom REI with you, which is a faith-based mastermind we're both a part of, where people are doing big deals and learning how to raise money and all kinds of stuff. So people can reach out to me or you if they have questions on that group.
Yeah,
Um, so let's get in and talk a little bit. I know you've been doing multifamily for a while. You guys have a portfolio. Can you talk a little bit about kind of how you got here and some of the stuff that you work, like just give a description of some of the stuff you work on as well?
yeah. I got tired of flipping homes. Did that since the early 2000s. Made it through the financial crash because our basis was really small. And so whenever the crash happened in 2000 and 2009, we some of them we just lowered the prices on, others we turned into rentals and had cash flowing rentals right away. And so that was a good lesson to learn, but did that for a long time. And it's funny, never achieved that point of freedom, point of choice where you no longer have to work for a living. So I was active duty Air Force. I was doing that thing, and when it came time to start looking at my exit from the military, I was like, I'm not going to do single family stuff anymore because it's a bear, and all these get rich quick schemes in there. Like, I'm gonna flip these homes, gonna make $1 million, and blah blah blah. And so we started looking at multifamily. I had to get some partners, so I started talking to my family. It's like, hey, would you like to work for free for me full time?
It sounds
And
great. Sign me
oh,
up.
it was awesome. Like, yeah, we'd love to do that, Sam. And had a brother that did that, and my dad came on, and we just jumped right in. Started, bought a couple mobile home park deals, and within two of them, I was point of choice right there. Like, I could never work again. I could retire from the military with that, and the mobile home park, we were good to
Right.
go. So,
So you were still in the military when you were doing this stuff when you started. You
yeah,
were flipping
so
homes and doing all this stuff on your own while you're in the military.
yeah, I'm a idiot. Yeah, for sure.
No, I think a lot of us, I think a lot of people listening, myself included, we have other things that we're doing or things that we've done, and it's hard just to go cold turkey and quit, and it may not be the most prudent thing to be able to do that. But you brought up something in the beginning that you shared that I think it's really true, is that, I was in sales for 10 years. I was in medical device sales, and there was a transactional type business. And I think flipping houses is a transactional type business. If you're a real estate agent, it's a transactional business. You get paid when you do the transaction. You sell the medical device widgets, you flip the house, you sell the house, whatever it is. But when you actually become an owner and you can use other people's money, and it sounds like after a couple deals in mobile home, you were able to become financially free and got to a place of I can choose. Like, freedom is I have freedom of time. So when you reached that point, did you quit or did you continue to work at your regular job, or how did you kind of move forward from there?
Yeah, so I still had time left before I could retire. Had a couple years, and I had almost no money. I had like 30 grand. I started with almost nothing. And 30 grand seemed like so much money. That was all I had. And my military has a version of the Roth IRA kind of thing. And anyhow, so you know, my dad blew all of his savings, 80 grand. That was his entire retirement, was $80,000, which is nuts. Shows you how much faith he had in me.
Yeah. Well, he probably knew you're taking care of him regardless, right? So he's like, well, I better
Yeah,
just put it all
yeah.
with you. So
Yeah, I'm gonna be moving in with you anyway, son.
yeah.
So yeah, I mean, we did that, and it worked out, and we ran out of money really fast. We're like,
Yeah.
okay, now what?
So you did two mobile home park deals. This is part of this mobile home parks. Like, how much did you raise, or how many, plot units was this, or I guess how many plots?
Yeah, they were just ours. The first one was 3. It was close to me. It was kind of like a, try it. But it was on a commercial lot and had some extra land that we thought maybe we could expand or do something. And then the other one was a 42 lot mobile home park. It had 38 homes. And it was about half full. And within 6 months, my dad working out there, we were free and clear about $12,000 to $13,000 a month.
Wow.
Free
And to do that one, did you basically syndicate it, or you raise money for that deal? Or is that all your guys' own money? Or did you do a seller carry kind of thing?
Yeah, so we did a master lease, something I learned on YouTube about. Reach out to me if you want to know about a master lease. I've done them multiple times now. They're awesome.
Yeah. Wow.
And yeah, I mean, those people had no business selling to me. We'd never done it before. But yeah, one carry, or sort of with a master lease, not really a carry, but the other one did an owner carry. And that one came with about $2,000 a month in cash flow right off the bat.
Wow. And that was a smaller one. So the larger one, can you describe just in real short terms what a master lease is? So obviously I'm familiar with a seller carry, but a master lease, can you just, for our listeners, explain what that is?
Yeah, so master lease, there's no financing involved. It's similar to like if you're going to rent your office, but the difference is like it's like a triple net lease, but it has just a little bit more things in it, with a leased option to buy it at the end, and you may get some credits for money you spent on the property. And so in this case, we spent $60,000 down, which paid for an entire year's worth of lease payments at $5,000 a month. And then we put $40,000 into a construction account that we then used on the property, because it was hard to finance a half occupied complex, but had a bunch of vacant units. So my dad went there and did the work. He'd been in construction for all his life, and so we did the work, rehabbed it, filled all the units, and then at the end of the year we had to this is crazy, so we had to go to the bank. We did, got a great local bank, got it for like, I don't know, 3.5% or 4% loan on a mobile home park, which is hard to do. And then the seller died the day we closed. We were trying.
Hold on, wait, okay. So you have this all set up, and the seller. Wait, I hope the seller didn't feel taken advantage of. But so okay, so the seller's old. So they sign all this paperwork. The deal closes, and then the seller dies later that day, or they
No, he
signed,
died
or
the night before closing.
oh, okay.
So the morning of
that's sad for two reasons. The guy died, which is really sad. It's sad for the
Yeah.
family. It's sad because you. So then, what did you do?
we just we all kind of like stared at each other like, what do we do? And the broker, fortunately, who had been working really well with us this whole time, said, I'm going to go figure this out. And so it turned out that he had a business partner who was able to sign for closing, but then we had to make sure that he really wanted to sell it. And so it took about 2 weeks.
Oh, wow.
I got everyone back together and closed, because it was just like
wow, that's amazing.
But yeah, but
well, go ahead.
Yeah, no, good. Yeah.
I was just going to say, it's always interesting to me how people get started, and they kind of go from like, okay, I was doing flipping, or I was doing houses, whatever. Then I did this deal or these couple deals, and I became financially free. And the income you're talking about is enough to be able to cover the nut, right? To cover okay, this is what I need to live, which for me, when I did it, it was only $5,000 or $6,000 a month or something. And I live pretty simply, but for some people it's more. But how did you what we're going to talk about multifamily. We're going to get into that in a bit, because I know that's your core business, but I think there's a lot of transformation in these stories. But how did you did you just hear about, did you go to a conference, or somebody told you about it, listen to a podcast? How did you get going with that? It sounds like you watched a YouTube video and found out about a master lease, which is awesome. But how did you just start shaking trees, or how did you find out that was even possible to do what you did?
Yeah, so I was, I think his name is commercial. I don't remember his name, but he does commercial property advisors, and there's these different, 5 years ago, there was far less YouTube people out there about syndications as there is today. There's a ton now. Past 3 years or so, 4 years, it's been a big explosion of the amount of content out there. So back then I was looking all the time, and I asked somebody, it's like, hey, I really want to do more, but I have $0. Like, how do you find investment? And one of the brokers I was with was also an investor. And we used to go look at properties all the time together. And he was like, hey, you should look at syndications, because that's how these guys buy these big places. And And that was kind of like what is that? And
Oh,
so
wow. Yeah.
then I, went out there and best ever. I don't know that he hadn't hit $1 billion yet, Joe Fairless, back then. And now I think it's like, I don't know, 5 trillion or something, whatever. He's buying everything. But
5 billion. Is he 5 trillion or yes, he'd be 5 billion?
yes, I don't know. He's probably 5 billion.
Billions, trillions. Yeah.
Yeah, whatever. After a while, it's just more.
It's just more than we've got right now, right? I get that. Yeah, that's
Yeah,
awesome. Yeah.
just an extra comma. Yeah.
Yeah. So going to
So-
conferences and learning. And it sounds, was it Peter Harris? Was that the guy's name who did maybe it's the commercial, maybe there's a guy named Peter Harris who does some stuff years ago who did that.
Yeah,
That's the guy.
sounds about right.
Yeah.
So, yeah, it just became, a an obsession almost, because I wanted to do more, and I couldn't get there, and so I just got, really, really, yeah, Peter Harris, yeah, that's right.
Okay, cool. Yeah.
Yeah, he was like my mentor. He doesn't even know it. I should text him.
That was, I think, the first book I ever read was Real Estate Investing for Dummies. It was co-written by two guys, Peter Harris and Peter Conti, which I don't know them personally, but it's a great book if you're getting started out. Besides the shaming title of the Duff for Dummies series, it's actually, you're not a dummy if you read it, but it's actually a good book. So I recommend it.
Yeah. Yeah, and he's a great educator. It's all free, and it's just really good. And I didn't know anything about mentors and how to find them. And, since then I've learned and repented in my ways. But anyway, so we went and I got some partners, convinced some people to work with me, and we basically just started shaking trees, and people gave me money, and I just thought, you guys are crazy.
Yeah, and they keep giving you money. No, that's good. No, I know you kind of, obviously we'll get to more of your story, but you have quite a few multifamily properties now. You've got a big portfolio. You have your dad is involved in the business as well, and you've got other friends and relatives involved as well, and other partners. Let's talk a little bit about what you're seeing now in multifamily. Now we're recording this. This will come out probably I would imagine in March, but we're kind of end of February here. What do you see happening right now in multifamily? You kind of said before we started, or in the green room, that basically there's a lot of deals that are starting to become they're getting in trouble. So talk a little bit about what kind of trouble deals are in, and what are some signs that a deal is in trouble?
Yeah, so I would say there's probably tens of thousands of deals that are in trouble right now today. How many of those deals their investors know they're in trouble? I don't know, but there's tens of thousands for sure that are in. Why? Because bridge debt was the way you had to buy, not always, but just about the only way you could buy a property in 2021 when the market was so hot. And you couldn't go and say, okay, I'm going to take 3 months to get this into agency debt. And the seller's like, no, I'm going to sell it to this guy. It's going to close in 45 days. And they wouldn't really close in 45 days most of the time, but they would get a bridge product that would be bridged to agency. And so they would get that product, but the vast majority of the tens of thousands of bridge loans that were issued were variable rate notes.
Right.
Which for the past, 100 years, when debt goes up, interest rates go up, it's usually 1, maybe 2 points max in a year. Okay. Most bridge loans are 1.5 to 3 years max. Now they're very short notes. The whole point is to either finish the renovations, do the improvements, because a lot of bridge loans will give you 80% loan to cost, maybe a little bit more. They'll pay for your rehab. And so all these value add deals, the market's hot, you got to move fast. Plus they're going to pay. You don't have to bring an extra $2 million of equity to the table.
Right.
Boost investors' returns.
They like that. Investors like that. And this is like 85% of multifamily deals out there, right? Would you say? I mean, I've heard it's pretty high. Is it that high?
It's really high. So bridge loans weren't ever a big deal until just recently, the past 3 years or so, 4 years, because of the market, because of a lot of private lenders offering bridge debt, and it was pretty low. Like we got bridge at 3.5%. That's a great loan. It was always a great loan on a project. But
when the other side of this too, Sam, I want to point out is a lot of people say, well, why wouldn't you just do fixed rate for everything. And you kind of brought it up, is that a lot of times you're having to put, 30, 40% down. The rates are maybe a little bit higher than bridge was also. So the number didn't work anymore, or the deal didn't work anymore. And then secondly, we've paid millions of dollars of prepayment penalties on fixed rate deals when we wanted to sell. So imagine, we have a deal, we've had a ton of profit, we're trying to refinance, we're trying to sell. We're just really unable to do it without paying, sometimes $2, $3, $4, $5 million in prepayment penalties, which is just saying that when you have fixed rate, there's less flexibility. So this debt, the shorter term debt, looked more attractive. And obviously there's caps that people have to where, the interest rate can't rise above, maybe you can't go up 2 percentage points. And there's like an insurance people get on those. But there are a lot of people that either don't have the caps, or they just, the deal doesn't work anymore. So let me ask you this question. How do you know as an investor if a deal that you're in is struggling? Or, how would you know that? Is it just any fixed, flexible debt kind of deal? Or how would you know that would be kind of something to be concerned about?
If it's flexible debt, it's a 99% chance it's in distress.
In distress, okay. Because just to show, because we have some all of our deals, I think maybe one of them is fixed long term. The rest are flexible. When you say distress, I wouldn't necessarily think that any of them are in distress. There's one that we withheld distributions on, but then again, we're in an area we're doing lots of value add, so we're seeing an increase there. But so you would say it'd be much, much higher. And how would you define distress then being like okay, this deal is in distress? So what would that mean?
Yeah, so there's really three factors that'll tell you if it's in distress. One, if it was high loan to cost purchase. So if you bought the property and you had a bunch, $2 million, let's say, of CapEx, okay, that was funded by the lender. So your basis is really high. All right. If your basis isn't that high because you didn't have the lender fund a bunch of stuff, it can be a variable rate note and your cash flow just got zapped, but you're not necessarily in distress. You're in a let's hustle and get the thing done so we can transition it into some better debt mode.
Sure.
But if you did a heavy value add or a mid value add with a lot of cash, you came in at 80% loan to cost or something like that, and you didn't have a rate cap. Rate cap started getting popular at the end of 2021, beginning of 22. Beginning of 22, rate caps got really expensive really quick. And so a lot of folks didn't do them. Saw a lot of more savvy folks did do rate caps. My whole portfolio, I have 2 deals on variable rate notes. And the one of them was in trouble and we're fixing that debt right now. The other one, the interest rates went up the interest payments went over 40 something percent. Or not 40%, $40,000 a month, $42,000 a month increase in your cash flow.
You're not counting on that. Yeah.
Destroyed.
Right. And this has been really interesting to watch because we had historic rates, rates that were historic lows for so long. I mean, there are people that have multifamily debt that's longer term, or even debt that's very, very low, like sub 3% type debt. And all of a sudden now we're talking like 7% is pretty normal, right? So that significantly changes the environments. Everybody's talking about the Fed. Everybody's talking about interest rates. We do a lot of economics, kind of macroeconomics on this channel, and we talk a lot about where are things headed. And I'd love to just get your opinion on, do you follow, macroeconomics, the Fed? Do you have an opinion of how long rates will stay high? Obviously this is just off the cuff. This is just your opinion, but if you have any thoughts, I'd love to hear your thoughts on that.
I think they're going to go up another 3 times, maybe 4. Inflation has not been curbed sufficiently. Report just came out in the past couple of days, late last week, saying that inflation's up still. So part of the reason inflation's been up is because of supply side stuff issues, but the Fed can't address supply side stuff. What they can address is demand. And so they're trying to squish demand. And the way you squish demand is make everything really expensive, which means a lot of people lose jobs. The lower socioeconomic classes get hurt the most, and the Fed recognizes this, and they operate that way, but that's what I suspect they're going to keep pushing. And so if we get to 9 or 10 straight rate hikes, you're going to see a lot more blood in the water. For example, even Blackstone is having trouble with a lot of their debt. And so they just put a lot of their loans into special servicing, which means they're probably not making the payments on those loans. And Blackstone's the biggest in the nation for sure, probably the biggest in the world. But $4 trillion worth of assets, and they made mistakes, right? Because the market, this has never happened before. And I told a group of people one time, like, look, nobody saw this coming. And one guy who, has a 10-plex and, knows everything said, no, that's debatable. Like, well, yeah, we all knew rates were going to go up, but 8 times in a row.
Yeah. It's not just, we had a panel recently. I had Ken McElroy and Neil Bawa, some smart dudes on the panel, and Neil Bawa said, a year ago we had, basically from a year ago to now, multifamily sales volume has gone down 78%. It's basically at a standstill because of the lending situation. I rarely now hear about new multifamily deals coming out. And the reason is just lending. We just can't find things. Now, once in a while, somebody finds a loan to assume, but even that's an issue because they've usually got to bring a bunch more money to the table, and that's challenging. So, we've shifted a little bit to do, at least for the present time, do some other assets. We've still got our multifamily stuff that we're trying to operate. We're going to ATM machines and car washes and other things. But Ken McElroy said this. He said he thinks that 2023 is really the year of operations. Really, that if you're doing a value add deal and you're coming in, and it's just got to be a super efficient process where you're coming in, you're doing this value add, you're seeing the rent increases, because there are places rents are still going up. If you're in certain markets, we're seeing in Jacksonville, Florida, it's still stable or going up. Other areas it's coming down. So we're seeing not only the press on, lending and costs, all this stuff is affecting valuations and it's just hard to kind of get a deal to cash flow. But then also with rents, we're not seeing them rise like we were before. So especially if you bought the last 6 to 12 months, or I guess even the last year or year and a half, it can be really tricky because you're trying to see, hey, can we just make sure these operations are going well? So you mentioned about opportunities. Obviously every challenge there is an opportunity, and there's that Chinese character is like the same character for challenge and opportunity or something, or crisis and opportunity. So what do you see? You mentioned something earlier, but what do you see as an investor or even as an operator, that what are the opportunities right now that this is presenting?
So let's talk about where the opportunities come from first. So let's say you're in a multifamily deal, cash flowing beautifully. Now your monthly payments went over $70,000 a month increase. Okay. You are making $65,000 a month in free and clear cash flow, beautiful to your investors. And now you can't make your debt payments. All right. You have a couple of choices real quick. You can go out there and find debt and transition, but that's hard right now. There's plenty of banks that I've talked to recently who said, hey, we're not doing any more multifamily right now. We're going to wait another 6 or 8 months and then try again. Okay. You can try and sell it at a loss, because I just saw a report this morning saying that prices have dropped by down to 2010 levels. Okay.
Prices for multifamily?
Multifamily. Yeah.
Are you talking about the value of a multifamily deal? Oh, so the total building, because I'm not seeing that in the areas we're in. You're saying the total cost now, or the cost to buy a place, is the 2010 level of buying a building?
Yeah, adjusted for inflation.
Or maybe adjusted for, maybe the valuation. So if you look at valuations versus, so the value may be higher, but the valuation metrics may bring it back. Okay, that makes sense.
Yeah. And then, so you can try and sell for a loss, right? Or, something, whatever you can get. It's probably going to end up being a loss for your investors, because most indications come in equity heavy because of all the fees and everything else that they charge. And maybe you funded a bunch of CapEx out of that cap raise. And so you're not sitting in a good value position over your existing equity, particularly if you bought in the last year or two. If you hold on, you'll be fine, but if you can't hold on, and then worst case scenario is, the bank takes it. And then a trump card you have, if you know how to play it, is the Chapter 11 route. And that scares the snot out of a lot of folks. So they would just rather take it to, chapter, or they'd rather just give it back to the bank or sell it. So at a loss. And so I know guys right now, I know a guy in Colorado, $50 million office building, let it go back to the bank, or he's letting it go back to the bank. I see every day, I see more folks, 1,500 unit portfolio, multifamily, that guy's letting the whole thing go back to the bank.
All right. We're seeing more of that. We see I saw an ad or something the last couple of weeks where there was a multifamily portfolio in San Francisco. There was a $500 million loan that people are letting go. And I think, it just comes down to, good operators, timing. I mean, there's some of it's just like, diversity.
Some of it's just timing. Yeah.
These
are successful guys, big guys, big and gals. I mean, it's not their first deal. Hundreds of millions of dollars of assets, or billions of dollars of assets.
Right.
And the market gotcha,
Yeah. It's so true. So you mentioned about starting a kind of a relief fund for, going after some of these deals that could be in distress. And what kind of terms are you seeing in those? So this would be like a fund if somebody's an investor and they're like, hey, maybe we could be a white knight and help, a distressed deal. There's a benefit to that. And then sometimes you can actually be stacked, you get a good return, and then you're stacked in as debt so that, if there is some sort of issue, you can kind of come in and maybe get some assets or get a much better deal on assets. So what does that look like? What are you seeing for that?
Yeah, so we helped place $5 million before the end of last year because the distress was already happening. Kind of ran out of cash, and then so we've this year, like you said, we stopped and we just been really focused on our own portfolio operations because things are tighter than they have been. But now we're kind of at the point where we started conversations with some other folks to try and put together a nice fund that we can go out and help multifamily operators or storage or other places where they have this debt and that they need time to cover either interest payments or whatever the shortfalls are so that they can get it to a position to refinance it without going tango uniform, as they would say in the military, but without going into default and then having all these extra problems. And so it's expensive money. But we've seen, 15%, 18%, 20%.
Oh, 15, 18, yeah, 20. So, okay. So yeah, that's expensive, but it can help. Sam, I really appreciate you, man. I appreciate you being honest and sharing kind of what you're seeing. And, it's always good to hear kind of from people that are on the ground and just are seeing stuff. And, we have insight into our markets and, where you're doing mostly, is it Oklahoma or what are the areas you're in?
I'm in 7 states.
Okay. All over.
Yeah, too much. Yeah, we're consolidating a little bit too throughout this process, and but yeah, we're still out there getting after it.
Yeah, it's awesome, man. Well, I really appreciate you being here, man. I appreciate you sharing and also the values that you bring. And I think it's just really great when we can have conversations around this stuff. But what's a way people can get in touch with you if they want to reach out to you?
Yeah, you can find me on Instagram, Clean Money Sam, talking about how we invest our money makes a difference in people's lives. That's why I love multifamily, because Bronson, you're changing people's lives as you improve a property and make a difference and provide governance and all these things, right? You're changing people's lives. It's not like stocks where it just goes into a stockbroker's hands and he buys a new Ferrari. No, like we're actually helping people. And so you can find me Clean Money Sam on Instagram. I'm on Twitter, talking about affordable housing a lot. Same on LinkedIn. I talk a lot about affordable housing. You can also find us at wildmountaincapital.com is our website. And if you are, struggling or anything else, and you're an operator out there, please feel free to reach out. I'm happy to help and provide some guidance if possible.
Awesome, Sam. Well, I appreciate you, man. Looking forward to seeing you at the next Kingdom REI meeting. It'll be awesome. So thanks for being here, brother.
Yeah, Bronson, anytime, man. Anytime.
So this was a great conversation. A lot of times I find multifamily operators just talk only the positives about multifamily, and there is some pain that's starting to happen. I wouldn't say, Sam used the word distress, and there is definitely distress happening in a number of deals, of his timing and just lending dried up, and especially some like new development type deals where there's no fixed rate debt. Literally, there's no construction fixed rate debt. It's all variable. So we're seeing some of those have challenges. And as an investor, if you're like me, you want to know that your investment's secure. You want to know that things are going to go okay, or going to at least get your money back. So it's good to check in with your operators, kind of check in on your deal, see how they're doing, make sure you follow what's happening. And obviously it's different in different parts of the country. If you're buying in a growth area like Jacksonville, where you have a lot of our stuff, it's a little different than if you're buying in Cleveland, Ohio. And I always use Cleveland, Ohio as an example because I own some houses there. And it's the population is flat or slightly declining. And so when population is growing, you tend to have an additional thing that allows for, it's just more growth, puts more pressure, upward pressure on rents and on property value. So anyway, I hope you enjoyed this episode of the Mailbox Money Show. If you haven't given us a rating, a 5-star rating, please go in and do that. Or if you're watching this on YouTube, please comment or smash that like button. It really helps us to get great guests and to continue to bring you value. So I'd love to hear from you if you're getting value. And if you haven't joined our investment club, you should check it out. We're doing some awesome stuff, oil and gas, ATM machines. We're also doing some stuff in the car wash space. So we're branching out just because it makes sense. Really it's important as an investor. You don't just look at doing a certain type of deal, because I've always done multifamily deals or I've always done houses. It's important that you keep learning, because it really matters what does the asset actually do for you. So thanks for taking the time to educate yourself. We'll look forward to seeing you on the next episode of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.